Hello, everybody. Welcome back um, to our weekly meeting, weekly get together, chat about trend following, trading, and whatever comes up. Fantasy hockey started. That's a great topic. And I'm traveling again. Not New York this time, but believe it or not, Las Vegas. It's 5 a.m., but I guess I'm kind of on East Coast time anyways, so I've been awake. But no coffee yet, so I'm not sure what's going on in this hotel. But anyways, let's get moving, get going, and see what's on everyone's mind. If you want something, if you have something to say, and you want to say it, raise your hand. And if you want to send me a direct message, that's fine too. And if you talk too long, I'll probably mute you and then unmute you later. So don't worry about that. Just trying to keep it moving, flowing. I need a mute button. Someone needs to mute me probably, but and I do get muted a lot. I just did a podcast a couple of days ago with Salem Abraham, and it's the first time he and I had done a podcast together and seen each other in a while. And it was the Meb Faber podcast. So be looking for that on Meb's website in a few weeks, I guess. So good morning, Oleg.
Uh, uh, Good morning, Jerry. Good morning, all of you guys. Of course, I will say nothing new, that I'm very happy to be here and I'm waiting for all the week, every day. And it's not a joke. For this our meeting to talk about one of the most favorite topics in the world, about trend following trading, about investing, about all of this stuff. And now I'm also in traveling. I'm in South City of Krasnodar. It's a megapolis in the South Russia. So I like also to travel much. And I like to be in different, maybe uncomfort situation. I don't of course, we all like comfort zones, but sometimes I force myself to go out from the comfort zone, to travel much, not always in the very comfort to a lot of people circumstances. So I'm very happy.
Hi Oleg, hi Jerry, everyone. Good to be here. I've been out for a couple of weeks now. It's been a long hiatus, but glad to be back. And well, it's just amazing how trend following works. And when you think it's going down, then you find out it's only your perceptions. But give it a time, and it will surprise you definitely. I love the guilts, man. I love it.
Yeah, we missed you past few weeks. It did not go unnoticed, and I'm glad you're back, Bruno. And yeah, I mean, I think there's so many like cliches and one-liners I have, but I know one I've had for a long time, and I have to keep reminding myself that you can't predict what these markets are going to do. Limit up today could be limit down tomorrow, and we're getting in with these entries, we're getting out with these exits. I try not to think too much about anything. There's no information in between, and when we get out and the trend has turned according to our system, it can go right back up and make us get right back in. So nobody knows what's going to happen. Volatility, correlation, these things can change on a dime. Loose pants.
Yes, and I have mentioned that people don't want consciously to understand this, that there is maybe they don't understand the way we tell them about this often. I don't know, but people want something about prediction model, that why. People want a lot of why, and maybe it's because under the influence of mass media or something like that, a lot of people like to listen experts, and people even now, I think it's the same experts say something, and maybe in a few months they say something that is not something opposite, and the same person listen this and say, "Oh, how good this expert is," and when the same experts say something opposite, that he was wrong, he is not. It's like a new truth. That truth was not truth, and here a new truth, and this is truth. It's funny, but people believe it, and I have seen this many times.
Yeah, I think everybody loves a good story. Everybody loves to make sense of the markets. Oh, now I see why X moved in that direction and Y moved in the opposite direction. But well, it's all good to explain what happened. The thing is, it rarely pays for the future. I mean, if you have a perfect picture of what just happened, it doesn't really mean that it can help you in a consistent way going forward. But anyway, yeah.
Yeah, bro. I want to say that I mentioned maybe a few months ago one guy. I don't know who he is. I don't know this guy, and saw his quote on Twitter. And he said there that he was writing that he was in a conference a year before. He was in a conference, crypto conference in Miami, and all guys here were talking that in 1 year, crypto will be Bitcoin will be near 100 United States dollars for one Bitcoin, and they were talking about this all the conference, and that guy said, guys, and if not, if you are wrong, and it will not be 100 United States dollars for one Bitcoin. And they said, what this guy is doing here? We're here, crypto guys. We are talking about serious things. And what is this guy is doing here with such ideas? And it's funny, but it's not funny. It's a lot of money flows in such, I don't know, it's maybe something philosophical conceptions. It's not funny.
Hi guys, how are you? I've been missing too a couple of weeks. I've been on Iguazu Falls in the border of Argentina and Brazil, which is a great place. I recommend you to visit if you can. And I agree with you but you also need a narrative to convince people, or at least it's the way to convince people through a narrative or marketing. If you're trying to do this with more people than yourself. And I think that's important. And I also think, that drill that Michael Mavosin said about what activity has more luck than skill. That if you want to be a tennis player and you play against Federer, you will never win. But if you play against, for example, Warren Buffett, when crypto is up, you can win many times, and people will say, well, maybe Buffett lost his touch and there's a new king in town. So that's something that makes it also very hard for this activity to do it right.
G'day everyone. G'day Jerry. I just wanted to know what everyone thought of Mulvaney's performance year to date. As at September, pretty spectacular if you ask me. 135% up, smashed their 2008 record. It's quite impressive, but they're not alone. The diversified systematic trend followers in general have performed so well this year. So let's hope it all continues.
I agree. Boy, it's so much fun to watch him. And how much fun would it be if I would have invested? That would have been really fun. Yeah, and then Bluecrest had a similar 100% return. There's a lot of big returns these days. I think a lot of leverage and a lot of I don't want to get Niels going, but I do think leverage does play a role in some people, and obviously it doesn't. It's not the sole reason, but it is some concentration. But here you have a systematic classic trend follower who is not concentrated and is really doing well. And I just love getting my hands on any quotes and anything he says in past articles and things like that. I heard that he was going to be on a podcast soon, a well-known podcast. I'm not sure if I should say who it is, but it may not come to be, but he committed, according to my friend, that he was going to be on a podcast. So that'll be fun too. But no podcasts are as good as the one Rich is on. Those are the best. I mean, people, you've got to get out there and listen to those things, download them, get on your treadmill. What a great workout. Get on the treadmill, help your heart, lose a few pounds, learn from Rich. I mean, you can't beat that.
Yes,
Thanks
by the
very
way,
much.
by the way, Richard, yes, you are, by the way, great. Yes, it's so because your narrative, your narrative, scientific. You show us a scientific narrative, not the narrative that euro will be the best in the world or dollar will be the best in the world and so on and so forth and such bad things. But you talk in a words of math, and this math is in a very maybe easy way to understand. Maybe my English is not perfect here, but I listen this and I understand this scientific approach, and I'm not a scientist, but I understand this. And I think that every person who really wants to think about trend following, about something really serious in investing, he will understand this. Even if he would have another approach, he will listen to you and will think. And I think it's a very big thing.
Thanks very much, Oleg. Interesting when we talk about the scientific approach. Effectively, our process that we use, which is, this extensive back testing, it effectively is the scientific method being applied to how we trade. But interestingly, when you look at the science and the modern day science and how they're sort of evaluating regimes that are far from what is experienced in this earthly domain, like around black holes and these sort of things. What they're doing is they're testing their models in these very extreme markets, and in a similar way a trend follower needs to be doing that. It's not just the history that's important to us, it's also testing your models on data that's never been seen before, and you can generate that data. Like my sort of philosophy in relation to back testing is that we've of course got what history is presented, but let's also see how our models fare in different regimes that has never been experienced before. So you can regenerate your data for these extreme markets that haven't occurred before, just to really put rigor into your backtest process to test the robustness of your strategies. And I think that's very important. It's not just what we've experienced that's important, it's also possible new regimes that we are yet to experience. We do need to sort of assess our models in sort of these foreign exotic markets.
Very interesting indeed. And I want to say that I have said this before, that it's about maybe narrative also, that few people said to me when I said to them that I'm a trader, they said the same thing, that they are not involved in any investment process, but maybe they're smart enough, but they say it such a thing that, okay, you all traders, a lot of you look good when it's okay, but your prediction models, sooner or later, every prediction in every field fails. So sooner or later, maybe in 10 or 15 years, and people give you money, and your prediction may fail because the world is unpredictable. And it was said for me by maybe 2 or 3 people who are not involved in any investment process and never were. And I like this. And I told that there is, and I remember that for one woman, she works in the university, and she said this stuff about predictions, and I said, no, I don't do any predictions. And she said, oh, so you have an algorithm? And I like this. I said, yes, I have an algorithm what to do. So I think this narrative is good for a lot of people, and I saw this, in fact. to tell about models, in an easy way, about algorithm, about scientific approach behind this. And like Richard said, we do our approach not because we are dumb and we don't know how to predict, because it's the best approach. And I have seen this, and I have said before that if it will be a competition between prediction global macro guys and between traders, and prediction competition. And I think that traders, trend following traders, will have much more good predictions than that global macro guys or experts from CNBC. I think so, because trend following traders know more how our world is organized. But we don't use this. We don't use this, our theoretical ability, because we don't need this, because our trading models are better than this and will give us the better results. And about predictions, by the way, Moritz did very good predictions. Jerry, as you remember, did this, but not in a way to do it in trading activity, only to speak about such things that is possible. And everything, almost everything, is possible. And we trend followers know this.
Hey, Rich, you just mentioned Mulvaney. Oh, first of all, glad to hear from you again. As I said, I'm glad to be here, definitely. So just think about Mulvaney, and it can't escape anyone's notice. Mulvaney's performance is astonishing, even for a trend following strategy. He's crushing this year, definitely. But it frustrates me how mysterious he is. The fund is. I mean, I understand what Jerry does. I understand what you do. I understand what Niels does. But Mulvaney is so hard to find information for him. And do you have any idea what's behind his strategy? I mean, is it a suite of different models? Is there any dynamic positioning or dynamic weighting of models, of a market selection? I don't know, of instruments. Do you have any information here?
Look, I have scoured the web, and believe me, I've gone into try and look at everything. And look, there are a few articles we have on Mulvaney. One of the things I do know is that he used breakout models. He operates in the long-term space, so he's an infrequent trader, but he is very diversified. But the key thing is, I believe that he pyramids into his trends, and what I mean by that is that he'll basically allocate a small bet as he starts getting into a trend, and as the trend progresses in his favor, he will increase the allocation. He never reduces it, I understand. So it's always just an increase as the trend gets better. So as the trend develops, he obviously gives more commitment to that price move. I don't think he volatility targets, so he doesn't go the other way. So he does increase it.
It's actually the opposite of volatility targeting, right? If he pyramids
I think
positions, he's increasing his position as the trend goes on. In other words, he increases his position as volatility increases too. So it's the opposite of volatility targeting. That's amazing.
Yes, and look, so there is a PDF that he did for his institutional people. I think I saw one done in, I think it was 2013. He's done one, I think, in 2018. There's a couple of these institutional PDFs, but have a look. It's what Jerry continually talks about, the processes we've all heard about before. He uses breakout models, so I think he's definitely what I'd regard as a classic trend follower, just like Jerry and just like my approach, etc. So there are none of these bells and whistles added to his strategy. It's very simple. So I just think he nails it. He does operate though with higher leverage. I know he operates with probably larger position sizes than what I'm comfortable with, and so that therefore accelerates his returns in favourable periods. So his 135% return, it's under a bit of good leverage, but also I think the pyramiding that he does into his trend probably also augments that leverage during positive regimes. So he certainly nails it when he's in a favourable regime, but correspondingly, when he does get into a difficult regime, you certainly do see this pogo stick effect where it comes off substantially. But that's just part and parcel of following the Mulvaney program, and you do need to have a bit of metal behind you to sort of withstand the degree of volatility that the program offers. But if you're prepared to close your eyes and turn your computers off and walk away, and come back 20 years later with a Forrest Gump strategy where you've left an investment in Paul Mulvaney in your top drawer, I think you'll be very happy when you come back to see what it's worth in 20 years' time.
Yeah, in Brazil, we report volatility and return on a daily basis. By regulation, we are forced to do that. And when I compare my strategies to the data on IASG or Nielsen Hedge, most of the data is monthly. And then I see those volatility levels of 30%, and I wonder what's the daily volatility for these strategies. It's not just metal, Richard. I think they have Wolverine's skeleton made of adamantium. That is.
Agreed.
Yeah, really. I wrote all of that down. I just wanted to mention that. I'll get my friend Andrew, who replicates SocGen, to get back to us with his fancy computers and algos to tell us exactly what Mulvaney does. I'm joking, but I guess
no. Please do, Jerry. That would be great.
That would be. But
let's hack him.
Yeah, I would say that he probably doesn't trade 200 markets, so that I'm probably not. He's probably not doing. So maybe it would be okay or easier to replicate him, because I think that's one of the keys for the success of the current replicator is he can replicate these CTA positions of the SocGen SocGen CTA index, trend index, one of those, with just a few positions, because of they don't trade that many positions, or if they do, they fall manage, which makes all the positions look more similar. So maybe he could do that, but leverage, definitely, no doubt. Adding into a trend and pyramiding, I think that's the interesting one. I'm not in favor of doing my definition of pyramiding, which is like all of us, Richard and me, we add into a trend when the system 2 gets hit and system 3 gets hit. And the way I trade with a breakout, sometimes system 1 through 4 could get hit at the same time, and then some other times it'll be more spread out. But pyramiding, I think, is somewhat different in the sense that it is what I would consider to be a violation. And I don't think he pyramids, so I'm not talking bad about him. I don't think you need to pyramid with his strategy and his leverage, but it would be something like, I can afford to put on one unit, and if I have a couple of ATR profit in this trade, I can afford to put on another unit, like a money management type thing. And I keep my trade level at a conservative number, and I seldom change it. So that is absolutely something I would never do. Would be to using that definition of pyramiding. Yeah, I would not want to do that.
I want to say that it's a very important topic to talk about, because this pyramiding is how a person understands this, and of course in the way that it's when it's pyramiding in a sense of pyramiding, it's a non-risk management. It's dangerous for risk management, and it's dangerous for account. It's one of the most dangerous things for accounts to do this for your trading activity. But diversification across time frames, it's one of the best things to do, to have few exits and enters, and of course to have a proper risk management for all of that. And so it's very important to define pyramiding from a diversification. It's very important, really.
And another thing is, I wonder if he ever reduces his position sizes based upon drawdown. The cutback rule, where you reduce your positions because you had a big drawdown. Seeing as how he has big drawdowns, and then he comes right back, he probably doesn't. So that's another thing too, is to that's going to, that the way I look at any sort of money management outside of taking small losses and diversifying, the core parts of the system. Anything else is like a non-system trade, and so non-system trades will make you perform less, have worse performance than if you only did system trades. However, I'm in favor of non-system trades. The cutback, when the drawdown is, you need to reduce your positions and your leverage and your future positions in order to stay in the game. It sounds kind of discretionary, and I think it kind of is, but I wonder if he does that as well.
Jerry, I don't know if he does it, but I remember that in an interview that is on Cover's site, what he says is that he doesn't do it. He doesn't override the system, and he says that it's inevitable for me to have these drawdowns, and I have to recognize that it's inevitable, and I won't do it because what he said is that he worked a lot on the exiting and stops mechanisms, and that the strength for him is to follow the system always, because if not, he will, as you say many times, he will lose a lot of sample size, so to speak.
Hi, everybody. Yeah, I have a comment on the pyramiding part, which I agree with Jerry's, or I think somebody made a comment that pyramiding is the opposite side of volatility adjustment. So as the volatility adjusters shrink size as the trend goes on, Jerry stays fixed size and the pyramider adds size. So he's on the opposite side of Jerry from the volatility adjusters. So but my question is from a philosophical standpoint. So let's say a trade is entered, and if the basic principle is that realized assets, realized profits are what matters, and that the open profits are, just house money. They're like casino money, so which you can afford to have big drawdowns in and allowed to have loose pants, and you don't really care much, but you really care a lot about the realized assets, which you don't adjust. So with this philosophy, you can allow, so you're basically splitting your dollars in valuable dollars, which are dollars in your pocket from closed trades, and then house dollars, which are open trade dollars, which you are allowed to have loose pants approach, and then just let it breathe, and then let them just do whatever it may. So if the dollars are split in these two buckets, then pyramiding makes a lot of sense. Because if I enter a trade and for which I risk only $1,000 from my valuable dollars, so I'm only risking $1,000 of the realized dollars, which are the NAV, which is the account size at this moment, and I'm only risking $1,000 on this trade. And now the trade goes on and it makes $2,000, $3,000, $4,000. Now that the trade is up $5,000 in profit, well, now I'm $6,000 away from my absolute stop loss on the real. So I have $1,000 allocated to the trade plus 5,000 of display money. Well, then I can pyramid now. I can pyramid now and still keep the $1,000 hard loss on this trade. The further away I go from this $1,000 stop loss on the real dollars, the more I can pyramid and increase, always guaranteeing that the total loss will be no more than $1,000 of real dollars, and all the fluctuations that are with the play money, with the house money, I don't care. So I could pyramid now, 2x, 3x, 4x, let it breed, loose pants. Now these are not loose pants, these are loose tents. This is a house now. And then you can just go. So if Jerry's and Richard's philosophy and religious focus on realized dollars, on the truly valuable dollars, which are the realized ones, which is the account size that I really want to protect and don't lose, but then I'm allowed to play with or breathe or have loose pants or loose tents or loose buildings with the house money, then pyramiding, it makes sense. And in the sense of sample size, I'm sure Mulvaney is not doing this discretionary. I'm sure that his pyramiding is part of the strategy, and it's part of the managing a trade. So yeah, you will have more buckets. So you will have a bucket, for example, okay, I double size at 6 ATR profit. Then I double once more at 12 ATR profit. All the while, my 3 ATR original stop loss is still there, and I'm doubling and doubling and I'm going. And this could be systematic. And then you can also backtest and put it in different sample buckets, the 6 ATR entry, the 12 ATR entry, and prove that they're statistically significant and they're still profitable without being stop loss. So at the expense of lowering the sample, you're actually adding trades. So it's almost like a separate system. Adding at 6 ATR profit and adding at 12 ATR profit, it's like just like what Jerry says, system 1 goes in, system 2 goes in, system 3 goes in. But adding at 6 ATR, pyramiding at 12 ATR, it's system 2 and system 3, which can separately backtest it. And if they show positive statistical significance, you're good to go. What are you guys' comments on this?
I think you're right. I think you're right. And I think this is why we see Paul Mulvaney, when we get to these extreme regimes, and we look at the performance of the different trend following funds, we find that Paul Mulvaney, he's multiples greater than the next competitor. And this is because in these extreme regimes, he's highly levered. So I think he refers to it as he progressively increases his allocation towards a trend. He doesn't use the term pyramiding, but I think our discussion sort of understands this as pyramiding. And I think this is what happens. So I might have 6 systems or 8 systems that progressively, as I get more sort of involved in an outlier, that you'll find that more and more of these systems become active. But I think Paul probably has a much greater expanse to his allocations. You know, he might do it 10 times, 20 times, who knows, for the length of the trends. I do know he's very long term, just like Bill Dryce. I think he's more sort of looking at the weekly timeframes as opposed to, you know, trading the daily timeframes. And it's very interesting that I tend to see those funds with the most wicked, you know, long-term performance tend to be those that stretch out even further, you know, out to the weekly timeframes, that sort of stuff. So that tends to be I think it's a case of, you know, you are investing much more heavily in outliers and, you know, these lesser trades. And the more you stretch out to these longer timeframes, the more you commit to the outlier as opposed to the normal distribution. But I agree with you, absolute. I think in this case, you know, I probably can't argue with that. I think you're probably spot on.
Well, I do think you would have a sample size problem. And I'd have to sort of get into it more and think about it. But I think basing your entries on the current P&L in a trade is something I wouldn't want to do. It's not, and I don't think it's necessary. And I think that even though I do agree that during some periods, quote unquote, we'll have this outstanding performance. But I think that just if I took my systems or that don't pyramid, and I'm not saying he does pyramid, but if he does pyramid, I'm pretty sure that I could leverage up my systems and overall make the same amount of money. And now, not during 2022, maybe, but that's the whole you know, problem that everyone talks about, like why does trend following do this or that during a certain period? And we all say it only ever promised us that it would do the best over a long period of time. And so, granted, he may, and then, anybody can see those drawdowns. And some of those drawdowns are the flip side of pyramiding, if he does pyramiding. And I pyramid to some degree. And in the sense that system 4 gets in a lot later than system 1. And if the market turns around, system 4 never gets in. So that type of adding to your winners, it's improper money management and capital preservation to pyramid, and it's not going to keep you in the game for a long period of time. That's why I don't think he does it. And if he does it, he and I would just have to disagree, and his record speaks for itself. And philosophically, I would not think that's a safe way to trade. I was thinking recently that we get a little criticized on podcasts sometimes of people sort of describing what the way Absolute was describing the trade level approach, the closed trade equity and the open trade equity. He wasn't criticizing, but I have been criticized for this, and just sort of not made fun of, but like, this is dumb. Why do you do that? Why do you have 2 separate equities or 3 separate, total, open, and closed? And I think in trying to explain this and how wonderful it is, and logically, and our little story about about trade level and risk management, that we get, I think it's dismissed. But if we would have said, or if we did this incredible research with a bunch of PhDs, and we came up with these algos that know how to adjust positions and put positions on, and proper risk management of positions and trade level. And we can't tell you what it's about, but let me just tell you, it is something super special, and you can tell by our results. People would be amazed, But I think sometimes our story, this particular story, ends up, it becomes an argument apart from the back test, which is the only thing that really matters. And part of the back test is staying alive and preserving capital.
Hi, Jerry. So first, a comment on saying that about the sample size and how deciding on an entry level based on the profits on a trade. It actually, that system 2 or system 3, which are the additional ones, let's say for a pyramiding, they do not have to be defined as a profits on a trade. Those system 2 and system 3, so pyramid entry 1, pyramid entry 2, can be system 1, system 2, and system 3 based purely on price movement. So just like your breakout, let's say 100-day breakout is based on the price movement, you can have a entry at 6 ATR above 100-day breakout, and then you can have another entry at 12 ATR above 100-day breakout. So those are just 2 different horizontal lines above a 100-day breakout. There are system 2 and system 3. They don't have to be defined by the profits from the initial entry on the 100-day breakout. And also, I'm still not understanding why you would object to pyramiding. And I'm not saying that I would do it or whatever, but we're just now hypothetically speaking, we're philosophically discussing. If you give utmost importance to the realized dollars and you have kind of a loose pants attitude with the open trade dollars, why should you be objecting to pyramiding if that maximizes the money per risk of realized dollars? So if the risk of unrealized dollars is $1,000 or 3 ATR and it's fixed, if you can make more dollars on the risk $1,000 on realized dollars with pyramiding, why wouldn't you apply it? Because whatever you do with the open trade dollars, you're doing to maximize the profits that you make on the risked 1,000 realized dollars. And if Mulvaney or somebody shows you a statistically significant and robust approach that you can maximize the amount of dollars per trade on risked 1,000 realized dollars, why wouldn't you apply it? Because this goes completely along the philosophy that you're applying yourself. You want to run this trade and you want to make as much money as possible on a fixed risk dollar amount of realized dollars.
Actually, one reason why I do distinguish between pyramiding and what my approach, which is this ensemble of different systems. And the reason why is that if, for instance, we adopt this term called pyramiding, so let's say that we have a particular single entry, single stop, single trailing stop system that as we increase our ATR, we take another bet using that same system. As we increase our ATR, we take another bet using that same system. When you're pyramiding using the same system, the system constraints are therefore saying that you're using the same trailing stop, the same initial stop, at different segments of the trend. Now, what this does to me, at least, is it confines your pyramiding to a particular class of trajectory of trend, so that when you get exited out of that trend, you lose all of your pyramided positions. Some of them might be profitable, but you lose all of them. An ensemble of different or uniquely configured trading systems have their own unique stop, their own unique trail, their own ATR definitions, so that you might get 6 pyramid positions versus 6 ensemble positions, but you'll find that when you get thrown out of a trend in an ensemble, you might only lose 1 or 2 systems. You won't lose all of them. That's the difference to me about why I prefer an ensemble of unique systems to target an outlier, which might have many different forms of trajectory, than applying a pyramiding method using a single system, applying that single system and progressively increasing the allocation towards a defined trajectory. Does that make sense?
I fully agree with this. I'm not talking about fully, but my position is that first of all, it must be independent systems, but in my view, only of course trend following system with a trend following philosophy. So as Jerry said, we have different exits. For example, we have different exits, different enters, and so these systems act in the independent way. And I'm sure that we must have the risk management role. For example, if we risk 1%, we must risk 1% for all of the systems, for all of these trades. Not 1%, for example, for each trade. Not so independent, I mean. Only independent in the way we enter the trade and we exit the trade. And the general rule, money management rule, for all of that. So we have some budget for each system from our maybe this 1% in this example. I see so.
Yeah, I'd like to come on a practical point of view and tackle this provocation that is really good, actually. Absolutely, Moses. Thank you. And well, the first is what Rich just said. The problem is that if you treat these added positions as different systems, the problem is that these systems will exit at the same time. So the benefit you have of low correlation between systems is gone, because they will lose at the same time. And when you try to apply these systems, I have to confess, I studied pyramiding systems only for short to medium term trend following systems. So I didn't go as far as 200-day breakout or 250. I stayed in the region of 100-day or lower. But in these systems, what I found is that when you add to the position, you have to lift your stop loss, or that's the way I found to keep my risk budget the same. So I'm risking 50 basis points per trade at the same time, because if I'm adding to a position, I'm increasing my exposure to that market. So I have to lift my stop loss in order for that doubled position or increased position mean the same 50 basis points from the entry level. So when I lift my stop loss, the thing is, at that time, the market is much more volatile. So when I lift the stop loss, the chance of it being stopped is increased too. And the result I found is that these pyramiding systems have a much lower hit rate than the classic no adding system. Sometimes they hit they hit the ball out of the park, but it doesn't pay for the lower hit rate. That's what I found, at least for these medium to short term systems.
Hi guys.
Yeah, I think there's two things going on here. I think, well, at least two things. One is technical, technical indicators, and the other one is money management and risk control. And I have researched some of these ideas. Like, just one thing that's kind of interesting is that we actually had these systems that were. We had these before where we had a fixed breakout for every system, and then we said one ATR passed all the way up to 5 ATR passed. And so that works okay. Yeah, that'll work fine. I don't think it works better than just paying attention to breakouts. I think I've never liked the results when ATR got mixed in to entries and exits. I think ATR has issues. And so, my opinion, it's best left to sizing the trade and determining the distance to the stop loss. But one of the things about that system where you take the 100-day breakout and add ATRs, every system is the 100-day breakout plus 2, plus 3, plus 4, plus 5, is it works, but as you could already guess, it doesn't always space out. And if you said, okay, I'll take care of that, it must be an ATR, one ATR from the last buy that will absolutely test out worse. It's inconsistent. You're not always doing the same thing. And I think that pyramiding, which is basically, in my mind, this something I would not recommend, and it's something that's totally it's only for money management reasons and risk control reasons. It's the opposite of what we do, what I do, and Rich does, which is we don't even take the breakout trades that are not pyramiding and use current equity or adjust the size of the trade based upon total open trade equity or the equity in that particular, the profit in that particular trade. So we're so frightened by this profit that's here today and then gone this afternoon, and then you're basing trades on that and trading size on that. We don't even use that for the trades we do that only look at the breakouts. And so I think that that's the issue. And, okay, so you can't go from asking me a question about this debate about robustness. And, there is another bucket for things that are 6 ATR above the last trade or 6 ATR above a certain breakout. That's fewer trades than the breakout trade, obviously. Okay. And so this is a debate on, is there enough robustness? Are there enough trades in this strategy? And then before I answer, say, would you accept this robust system? I mean, of course I would, but that's a given. Okay, I'll accept it, but we haven't gotten there yet. We're still debating whether it's robust.
But Jerry, the trades, the system 2 trades that enter 6 ATRs above the breakout, those are the 5% trades which make bulk of your profits in the strategy anyway. I think we discussed this in an email when we were saying, hey, how about you forget the ones from the trades that kind of go back and then come back into the normal part of the distribution, and you just focus on the ones that are really out there. And if the 6 ATR entries, 6 ATR above a breakout entries are not statistically robust, and if 95% of your profits comes from the trades that go 6 ATR and above, they go to 10, 15, 20, whatever the outliers may be, because you're hunting for them, then there's a contradiction. If the trades that make bulk of your profits are not statistically robust, then your full strategy is not statistically robust. Am I correct?
But I didn't say that it wasn't robust. I just said that's the question on the table, and that's the question that you always have to ask. And I didn't say that. And but I think that another thing I think you give me the impression is that another thing we don't agree about is the sample size is all of the trades that were generated by the entry, exit, stop loss, the different system entries and exits, and they're not segregated by their size. So, and I don't think I've done this research. I'm sure. I would be doing it. Okay. So by the fact that I don't do it, I know that the plain breakouts, they're better. They make more money than 6 ATRs above something. And once again, we're mixing up topics. One topic is when are you going to get in? When are you going to get out? Pyramiding, the way that we were discussing it with Mulvaney, it's not a superior entry and exit. I've already said that. So, but what we were talking about is people were speculating pyramiding in the sense that he's increasing positions in more of a money management point of view, and increasing it based upon recent performance of a trade and being able to throw on bigger positions, when the markets really get going. And yeah, that probably works. It obviously works for him. If he's doing that, then I would say that works. But overall, over all of the trades, it's not going to do any better than not pyramiding.
Exactly. Hi, guys. Hello, Jerry. So, just to give you some background, so I have researched this pyramiding. I have coded it. Okay. So it's a quantitative question, actually. And it's very fascinating that sometimes, people just try to approach it different angles. But as Jerry has said, if you have researched this, and I have written thousands of lines to be able to code it, actually, you come to a point that I am not implementing it because the results are not superior. And I really mean it. I spent months and years on developing my trend systems and tested many things, and this is just one of them. So basically, pyramiding is just another way of adding up the leverage. Okay, so that's it. So pyramiding doesn't. So a good trend follower wins somewhere else between 30 to 40%. Okay, and if you're gonna pyramid it, the first implication is you're gonna drop that 30 to 40% to somewhere else between 10 to 20%. And I'm not, speaking from my gut. I've just, as I mentioned, I've, tested these systems back and forth. So that's the first implication. The second implication is your drawdowns are going to go much higher. Okay. Let's say that you really, there are some people who can trade 10 to 20% systems. Fine. Then your drawdowns are going to be significantly higher. All right. So you're even fine with that. But when I look into the notional leverage, which I look into the notional leverage, because I'm coming from a background that is not trading, so looking into the notional leverage is the purest form of leverage. And when I multiply that notional leverage with the point value to be able to assess the real, bucks for the leverage amount, I see that the pyramiding is just increasing the leverage. Okay, so you don't do that. So if just use one entry, one exit, one stop, and diversify it among so many markets, and if you use the same amount of leverage, your results are materially going to be the same. All right. So it's only the question of.
I think.
Go ahead.
I think that, of course, I think first of all, for me personally, first of all, I have two things in trading that are very important. First of all, it's risk management, and the second thing is diversification. So, if we increase our leverage, of course, the pyramiding, it's not proper risk management at least. And I think that it's not only not proper risk management, it's even worse than that because it's making maybe even less robust. I don't know this exactly, but I think that I'm sure that doing it in such way increases our probability to ruin all our money, to ruin our account. So it's at least a non-proper risk management. And if we do such a rule that it's limited, then it's not robust. If it's limited, so we increase for a certain level, not increase limitless to a certain level, maybe 6 times increase, 7 times, or 10 times, or 3 times. We limit our robust. I think so. But in both two situations, we do not do well for our trading activity. We don't. It's so I don't like this approach.
But there's a reason. Just let me say that there is a reason why you want to use pyramiding. So okay, so we've discussed that it is going to increase the leverage. It's going to make your drawdowns worse. It's going to make your hit rates 10 to 20%. But there's one reason why you might want to use it, and turtles have used that in the past. Why? I mean, according to it's not correct. So turtles haven't used that, but turtles, it would be a better strategy if they would have used this in the past, and I would have used this in 1980s. There is only reason why I would have chosen to use it is because the number of markets tradable are not that many. So to be able to capture the trends in the 1980s world where you only have 30 markets, futures markets to trade, then yeah, of course you would want to ride those existing trends. But now we are in 2020 and the number of markets is too many. You don't need that. So you just need to go one entry, one exit, one stop, and risk manage it like that. And I'm not talking about my gut. I've tested it back and forth, and the results are always the same. So so long as we have so many markets to trade, it's pointless to pyramid. Thanks.
Okay, so can I comment? All right, I think we're applying two separate standards when we're talking about whether something is better or whether something works or it doesn't work. In a lot of the Alps and Oleg's conversation, when you're discussing drawdowns, performance, and Sharpe ratio, you're talking about total equity, closed and open. So all your dollars are the same, and you're judging the performance of a certain adjustment in your strategy on your total assets, on your total dollars. Your open profit dollars are the same, your closed dollars are the same. Where pyramiding comes as a proposal, and I think it goes along the same philosophy that Jerry and Richard are saying. Both Jerry and Richard, when I say I can have the same or better performance than not adjusting for volatility, if I just ramp up leverage, and I'll have the same return to drawdown ratio as you or better if I just ramp up volatility. So, but what Jerry and Richard are saying to me, this, as I understand it, and what I think the pyramiders are also arguing, we don't care about Sharpe ratio. We don't care about drawdowns with house money. We do not care about drawdowns with open profit. We religiously care about the real dollars, which are dollars in our pocket. But as far as open trade, if you want to maximize, what we're trying to do here, not maximize Sharpe ratio, not maximize return to drawdown ratio on all dollars. That's not our goal. Our goal is to maximize the amount of dollars we make per real dollars risked. By real dollars, mean dollars in my pocket, actual close trade, realized portfolio, trade value. That trade value is sacrosanct for me. I will never risk it. I will always risk fixed 1% or $1,000 or whatever. Whatever else I risk, it's a completely different category of dollars that I'm playing with. So when you guys are talking about risk management, okay, what pyramiders and what I think also Jerry and Richard are saying, Jerry and Richard are saying, yes, we do care about risk management. We manage the risk of our real dollars very carefully, but we kind of have a very loose pants attitude towards open dollars. That's what the pyramiders are saying. I don't care about a huge drawdown with open dollars. So if you run a backtest with a pyramid and you conclude that for every $1,000 risk of real dollars, realized dollars, you make much more dollars per trade per entry.
Yeah, but your returns
then
are
without
not
pyramid, then why wouldn't you use the pyramiding if that's your criterion? Your criterion is to maximize the dollars that you make per risked real dollars.
By if you just normalize it by leverage, you're not making more money. Okay.
But I don't care. What do you mean leverage? Listen, we're all leveraged. So I don't understand.
No, what I'm saying.
But you're asymmetrical. See, listen. Even if when you don't adjust for size,
leverage is a very mathematical concept. I'm just talking about your notional leverage. So you're being paid by your notional leverage. Okay.
But Jerry's and Richard notional is also going through the roof as they don't adjust size. I'm the one who says, hey, you should adjust it for the volatility because now you have too much risk.
Yeah, but I mean, when you enter a second position on the same trend, your notional leverage is going to be twice as much.
So what? It's 3 times, 4 times. Let it go. You're still only risking $1,000 on your real dollars.
Yes, and so you're just fine if the market doesn't gap up over you, like 1987 or the CVC of 2015 doesn't happen.
Yeah, it's open money. You can lose it. You can lose it all. It's open profits. It's not risk management.
I'm on absolutes wavelength, and I totally understand where you're coming from. And what we're saying is that it's our realized balance that is critical to us. But as soon as we commit our trade, and we've taken care of that realized balance with our initial stop, and provided we use some form of trailing stop mechanism like a chandelier trailing stop or whatever, we know what our maximum risk on our realized balance is going to be. But thereafter, all we want to do, leverage aside, we want to maximize our opportunity. And I totally understand what Absolute's saying here. The only thing I would say is that there is a slight benefit between, say, an ensemble of trend following systems versus a pyramid methodology. So let's assume that a pyramid methodology gives you a pyramid sequence of up to 10 positions that progressively increases your leverage using the same trend following model. An ensemble of systems, let's say you've got an equal risk bet on 10 trend following systems that give you the same level of leverage as your pyramiding. I would say that there is one single benefit you are getting from the ensemble, and Bruno brought this up. What happens with an ensemble of trend following systems that are uniquely configured? You get a slight correlation benefit in that ensemble because they are not perfectly correlated. You will find that the pyramiding sequence, each of those trades will be fairly perfectly correlated with each other. So when you're trading an ensemble of systems in that tail region, you also get a slight benefit from an uncorrelated relationship between those systems. So apart from that, I do agree with Absolute's ideas here.
I mean, guys, actually, look, as I mentioned, I've just tested it back and forth. So if your returns are as a function of your leverage when you go through that pyramiding. You can get the same results without the pyramiding, so long as you just need to apply the same leverage. Okay, so that's the heart of the matter, you know. And because I have quantitatively tested it, I'm 100% sure that it's just you're playing with the leverage.
But Alp, you're comparing optimality. You're comparing performance with different standards. Okay, you're comparing performance on total dollars. What pyramiders and Jerry and Richard are saying, and they're maximizing. They're trying to maximize the amount of dollars and profits made per real trade, per trade dollars risked.
Yeah.
Which is different.
Yeah,
so
of course.
so,
No, it's not
so
very
these
different.
are different parameters, of course.
No, it's not different. Everything else is the same. I exactly on the, you know, I agree with the parameters that you're using, but I'm saying if we're gonna use a constant leverage multiplier for a trade, so what I'm saying
well,
is,
no, we don't want to use, because Jerry and Richard don't use constant leverage. They don't care.
No. What I'm saying is, I'm not saying let us use just one leverage. What I'm saying is to be able to compare apples with apples if we have a leverage budget. Because of course, if you take,
but it's a different apples. They're comparing different apples. They're asking how many dollars per trade can I make for $1,000 risk of real dollars. That's the apple.
Yes, but once you put that leverage, your risk increases. Of course, you know, because I've tested it. I'm telling you.
Yeah, I know that you've tested it. I've tested it too. Everybody has tested it. Okay,
No,
I understand.
It's not that easy. Once you do the pyramiding, of course you're making more money. But once you adjust for the leverage, so this is where your money is coming from. So if I use exactly the same leverage on one entry, one exit, and one stop model,
okay,
I do exactly the same amount of money.
So I agree. So I don't know why we're arguing. That's fine.
Well,
things are getting really heated here.
Yeah, let me.
Jerry, just let me ask a quick question here. And so, as I said, when I tested these pyramiding systems, what I found is that and now I'm looking at those classic trading stats that we all love and compare. I'm looking at hit rate, that is the proportion of trades that had a positive return, and the average win in relation to the average loss. That is, how much do I make in terms of initial ATR in relation to how much I lose on losing trades. And with these two statistics, I can calculate the average return per trade. Okay, so when I compared the pyramiding systems, I found that the classic simple systems had a better hit rate and an okay average return to average loss ratio. Then when I compared to the pyramiding ones, they had a worse hit rate. That is, fewer trades make money, but they have a better win-loss ratio. The problem is what you get with the increasing hit-loss ratio doesn't make up for the losing hit rate, and the result is the average return, the expected return per trade, is worse. So with these results, I found that the pyramiding systems are worse than the classic systems on these closed equity basis we all talk about here. So my question for you, Absolute, is: did you find different results, or no? Are you just entertaining the possibility of what if pyramiding systems have better trading expectations? Because if that is the second option, what if they have better trading expectation? Of course, we all would sign down.
Okay, to answer the question, what if? So you're saying these results that you had are based on closed equity and do not care about open equity?
Correct.
So not on the total assets.
Yeah, exactly. Based on the initial assets before
Okay,
I
but
entered the casino.
okay, but it also depends on how tight your stops were and whether you have a hit rate. How much, it depends on a lot of parameters. But
Yeah,
if
definitely.
pyramiding for the same strategy, so this is how I view this. All right, when let's say on a breakout, 100-day breakout, you enter a size and you keep it fixed. So your size is 1. I'm gonna keep the size, call it 100%. It's 1. You have also other functions than a constant 1 function. One function is you can, as you go into profits, start playing more with house money and then start to increase your size. So you're as you go to 3 ATR, you increase 1.3. As you go to 6 ATR, you can go 1.6. So you have different monotonic raising or lowering functions. If you want to go mean reversion, you can go from 1, you can go 0.9, 0.8. If you want to just take profits slowly off the table, there's different functions you can use to allocate, whether depending on how aggressive you are or not. So my point is it determined that keeping this function at 1 maximizes the amount of dollars you can make per $1,000 risked of closed capital? My argument is that for 1 to be the most optimal function for all markets and for the whole universe, let's say if you diversify it, it's very unlikely. Probably the amount of dollars you can make per trade on $1,000 of closed capital risk is a monotonic raising function above horizontal, which means pyramiding. So what that function is could be exponential, could be linear, could be quadratic, I don't know. But what pyramiding is, this is just asking the question, why do we have to stick with the function of 1? Why do we have to be 1 all throughout the trade?
Absolutely, it's called leverage.
Get it.
All right.
I think.
In the CFD world, you can take. Look, we're talking about.
But we're talking about fixed risk here, guys. The risk is still the same $1,000.
Yes, of course it is. Yes, of course it is. It is. It always is. But you're adding more units. The leverage, there is something else called leverage. It's going to shot up to the moon, that leverage, after a while. Of course.
Well, you can correct it. You can adjust it with your monotonic function. You can make it as much as you want. If it's too much, then pick a different monotonic raising function.
You can buy 1 contract after second contract and the third and the fourth, the fifth, and I have tested up to 10 pyramiding positions in one trend, and it works. It just takes the hit ratio to 10 to 20%, and some people can ride it.
But what do you mean by hit ratio? Of course, then if you keep the stop too tight, you're gonna get stopped out and nothing's gonna happen. You're gonna probably even get kicked out of the trend.
Yeah, of course.
If you only play with house money, your stop will be way out. You're not gonna get kicked out.
The point being is not about the house money. I'm talking about the total benefit. You don't get any benefit. The only benefit you get is because you're having more leverage there. That's it. And
I still don't understand why is leverage so important. Can we not talk about leverage? We're all leveraged here, more or less.
All right, I'm going to put a limit on pyramiding for the rest of the day. So let's move on, and you guys can duke it out offline and get back to us. I'm pretty sure at this point, I don't know what pyramiding is. Or the difference between what I do and pyramiding, but I will say that it's not that interesting of a topic. But I'm going to try to get my thoughts together on this whole thing so I can talk more coherently.
I thought volatility targeting was bad until we started bringing up pyramiding.
Yeah. I thought I knew what it meant, but I'm a little confused as to. I remember a very famous trader friend of mine, when I first met him, he told me, he described his system of continuing to buy into the trend, just continuing, like as it went up, it was just like buy all the time. And yet he also told me pyramiding was not a good idea. So I've got to figure out my thoughts on that. And but yeah, it's a bit confusing. But I will say that all of this adding into the trend and buying more and pyramiding, some of those trades, the problem is those trades, some of them become losses, and they detract from our prized closed trade equity. So that's why I'm very concerned about them. And I think Absolute brought up a good question. A good point is that some of these terms we use, they're kind of counterproductive, and we need to. It's hard to. Everyone's doing something slightly different, and we need to kind of recognize that. Yeah, sorry.
Jerry, can I ask you something? Do you think that the current performance of trend following will again bring lots of assets to this part of the industry, and this time? And do you think that will affect performance or not?
Well, performance will go up and down, and this is a great period. So it could continue to get great and better and better, but then at some point it's going to turn around, and as the markets sort of just turn around and consolidate and do something else for a while, and more than likely CTAs will have maximum AUM, and it'll certainly be blamed for it. But I doubt if it's really would be a real reason for it. But I'm sure, and I think what the whole world is sort of on the path towards is you've got to have shorts, you've got to throw commodities in your portfolio, and you just can't be safe and own stocks and own bonds all the time. And you just can't have things in your portfolio that have historically worked from a buy and hold point of view. There's just not enough. So I think that's the path that the world is recognizing, that you've got to, in order to protect capital, you've got to be more afraid of being against the trend and being concentrated with mostly just stocks and bonds. So hopefully that's one of the lessons that people will take away from all of this. And an 8% return and a 50, 60, 70% drawdown is what everyone's going to get in stocks over a long period of time. And I just find that kind of intolerable, and especially given the love affair that the world has with, or at least in the U.S., with equities. It's unwarranted, but who knows? I think for all of us, it's probably better if trend remain. We talked about this last week. I think if trend remains a niche business, so we can all make money and not have to worry about big institutions.
Yeah, because this time I was comparing from when guys like Winton or AQR were riding the AUM wave, the last one, and then they kind of adapted their systems to being less trend following and more diversified, and they were very good marketers or had huge marketing engines. And now it's like a different wave, because it's like the old school managers are back and they sell differently. So I was wondering if lots of people will go back to trend following, or maybe, as you said, will remain a little more in the niche. Because I think that when people like AQR or Winton, etc., start to deploy lots of capital, they kind of affect in one way or another, at least short-term performance.
Hi, Jerry. Hi, everyone. Yeah, very interesting discussion about pyramiding. It's a confusing subject. Different people mean different things when they talk about pyramiding. And to my knowledge, I think that was a risk management method used by pit traders, the open outcry. They started small, like Richard Dennis, they started small. And the reason was the bluffers. They didn't want to get caught in a bluffing scheme. So they started small and they added slowly, and possibly they got up to the max risk they would have taken anyway. So it was not really adding risk, it was avoiding stop or minimizing their losses. And then there is the other type of pyramiding that you use, you add to the risk. That's very dangerous because it increases the risk of ruin. And it depends, as Absolute said, if you are trading your own money and that's your pocket, that's your money, your own pocket, then you can do anything you want. But I'm not sure a fund wants to do that, because you end up with maximum risk and leverage when the markets turn around. And that increases the drawdowns and the possibility of ruin. Anyway, I agree with Jerry. It's not an interesting subject.
I know, but you said it was really interesting. But, well, maybe this conversation, those two guys, Alp and Absolute, that was, I know we'll get to the heart of this. And this is a fun thing. And I know it seems a little chaotic, but I hate to cut people off. They were going, and we'll pick it up next week or in the future. But so I will say that buying the 100-day breakout with one contract, in Absolute's example, he said one contract, then if it goes up 1.3, the 1.6. I know that if you just did the whole 1.6 at the 100-day breakout and didn't add to it, it would be totally fine. You're not going to make less money or more money. It's going to be about the same. I think the breakout itself is more robust, and so it's probably going to be a bit better to buy the 1.6 or your whole commitment. I think what I was trying to get at was when you decide how big you're going to trade, I am comfortable trading 1% of my closed trade equity or total trade equity, whatever, for this discussion. Then figure out how many contracts that is, and then spread it out. So in the very beginning, when you set your system up, that's your decision. 1% of closed trade equity, 1% of total AUM for all my trades for this market, for British pound. But then if you want to spread it out based upon ATR or based upon different breakouts or moving averages, that quantity that's based upon 1% of your capital, that's what I recommend. Now, another mindset would be, yes, I am going to use 1% of my OTE, and I do think that is safe. But if I get a profit in a trade, I'll do another 1% because I have that profit. That, I think, is not as safe. And I think if you just wanted to do the whole 2% at the breakout and forget about, I think, that would be just as good or better. But I don't know. I broke my rule of not talking about it anymore, and I started talking about it. So what else can we get into in our last 30 minutes? Anyone?
The pyramiding discussion left us a bit numb.
Well, I'm sitting here in Las Vegas where there's a lot of gambling going on, and I have no interest in gambling here in Las Vegas, and I haven't had any coffee. But last night we were kind of joking around because a lot of people were gambling, and they were doing the roulette. And my wife, be honest, her response was she was like having a good time making money, winning money. And her response to people who were joking around was, "You don't understand math," or something like that. And I said to her, "Well, we do understand it, because if you understand it, when you you don't walk in the front door, or you keep your hands in your pockets." So it was pretty funny. But it is really something. I love fantasy sport, fantasy football, fantasy hockey, but I cannot part with my money. It's not like entertainment to me to play a negative sum game. You know, one of the first turtle lessons was to try to educate all of us, because we came from we didn't come from like math backgrounds and stuff, so they had to sort of tell us a lot of basics. But one was the proper way to trade trend following was minimum boldness. You just trade small all the time. Your whole idea is to stay in the game. You have an edge, so you'll eventually win. You just have to hang around long enough, not overtrade, not pyramid, haha, and just let the numbers play out in your favor. But a negative sum game, where in Vegas, the odds are slightly against you. So the proper betting strategy is to come in and throw it all down at one time, place your money, decide what you're going to risk, and then walk away. And so I never forgot that. I thought that was so profound. I don't know why, but I'm not even going to put my money down and walk away. I'm just going to walk around, people watch, and drink.
I like this. Okay. I want to say that I like this. Why? Because we have about the expectation, positive and negative. And so when we go to Vegas, theoretically, we can have 100 United States dollars in our pocket. And we can win 1 million United States dollars. Once we can go. It's theoretically, we have this possibility, very low, but we have. But if we will go to Vegas, maybe for 1 year, we will lose anyway. I'm sure we will lose all our money. Regardless, we had win this 1 million United States dollars from 100. And with proper trading activity, we see the opposite situation, that we can have months of drawdowns, we have this different periods, so on and so forth. But in fact, we see that our math expectation, our parameters, our diversification, long and shorts, like Joe says, will lead us to be a long-term winner. And this long-term perspective is the most important things here, most important thing in business, most important thing in trading. For me, one of the most important things is a long-term perspective, investment horizon. And so in some things like Vegas, investment horizon, long-term perspective, that you will only lose all your money, I think. If you are not maybe a genius like Leonardo da Vinci or something like that, maybe so.
More like Ed Thorpe. Ed Thorpe sort of took his physics to the roulette table and realized that there's an inherent bias in every roulette table, and all he needed to do was apply the physics of centripetal motion and where the odds of the ball, the speed and the velocity of the ball, and I think he applied a bit of Newtonian physics with a computer in the heel of his shoe, which gave him the odds of falling in particular quadrants of the wheel. And I think he was incredibly successful, and to the extent that I think he was banned from casinos. But I think when we make assumptions, I think the casino is an excellent area to first sort of get your head involved in statistics. I spent a lot of my time, early youth, in casinos, looking at the different games and looking where any edge resides. And I think it's a marvelous learning environment that sort of gets you ready for the weak edge that we deploy in this trend following space. I think it is a weak edge, but I think our technique exploits that marvelously. By focusing on the tails where there's this serial correlation in the price movement. I think that's where our edge resides. But I think all of that ultimately came down to my experience, I think, based on my days in the casino, which sort of enlightened me in that way.
Interesting thought, I think, because maybe near 20 years ago, I was my friend. He's a talented mathematician, and he went to casinos with his mathematical ideas, and he had very interesting ideas, and we went together. I saw how he did this, not in the sense of gambling, but to do something in mathematical sense. But it led to nothing, because maybe I think in Russian casino, I don't know about casinos in the US or Australia or wherever, in Russian casinos, at that time, now there is no casinos in Russia, I think, not much at least, according to law. But at that time, it was very, very unfair. So in the same roulette, I saw that the ball was on the number, and then he was kicked out in a marvelous way from that number, so on and so forth. Different computer programming against a person. And I thought, 20 years ago, because I was a student, I thought maybe 16, 17 years ago, 2005, I thought maybe it's a better way to be in an environment where it's 50-50 probability to win, but not in that unfair casino where not 50-50, where 90%, 99% against you personally, against a person personally, because of the magnets there and different unfair, other unfair different things. I don't think that, I don't know, but maybe it can't be so in Vegas. I don't know, maybe there is regulation, US regulations here. I don't know. In Russian, there was no regulation in this field. So here's my tips.
Yeah, this thing about casinos reminds me. By the way, I really don't like casinos. It was maybe a long time ago when I was working at Bell Labs. We went to a team something event in Atlantic City, and everybody was like so excited to go into the casino. I got in there with all the lights and the carpets and the colors, and since I'm also statistically educated, knowing that this is enemy territory for me because I have no statistical edge wherever I look, I just had to get out. I just could not stand it. So but this Richard's, I've also read Ed Thorpe's book, and I also read about his escapades with the casinos. This reminded me of how every table has had some intricacies, whether it's tilted or whether it is not perfectly horizontal or whatever. And this also made me think, and I connected it somehow strangely in my mind with the tweets exchanged with Jerry this week about equities, and how I view the equities markets and stocks and indices and everything. I would put the analogy as a roulette table which is tilted, and it's tilted in one direction, and it's tilted from fundamental reasons. And the reasons for which the equities roulette table is tilted is the fact that billions of people wake up every morning and are more likely to create value versus destroy value at their work or projects or whatever they're doing. So this is the mankind's tilt of the equities roulette table. And I think if Ed Thorpe was trading this roulette table, he would take advantage of this tilt. And I think of course you can trade it if it's not tilted, and you will probably make money. But I think whoever's not adjusting to this tilt or taking advantage of this tilt is leaving money on the table on a risk-adjusted basis. This is my comment.
Yes, absolutely. And look, one of the reasons for that tilt, of course, is because it depends what equities you're trading. If you're trading in single equities, if you're trading an index, there's definitely a long bias, a long tilt to it because of the method of index construction. With individual equities itself, I do believe, however, that even all businesses suffer under the principles of the Pareto distribution. So you inevitably get a small collection of those businesses being ultimately successful, with the vast number of businesses being unsuccessful. So I think there's this Pareto influence in the economic markets, which inevitably puts this sort of tail bias towards the markets itself, where the dominant change is driven by the tail events as opposed to the incremental change that can be achieved by oscillations about equilibrium, etc. So I see your point, but I think that the reason we predominantly trade in a symmetrical manner with our equities is not because of the equities themselves. It's because the symmetrical way of trading our equities is also linked to the symmetrical way we trade our commodities, the symmetrical way we trade our bonds, etc. There are correlation benefits received by going short on equities across a diversified portfolio. If you're trading equities alone, I'd tend to say yes, probably trade them with a long bias. But because we're trading them as part of a diversified portfolio, I think the shorts in our equities are actually beneficial for other aspects of our portfolio that's wider than just equities itself.
Yeah, it's a slightly tilted table. I'm not saying you shouldn't go short. It's just be aware of the tilt.
Yeah, so I guess probably a lot of us need more detail. And if you don't say tilt, I won't say leverage. And so just to make it very simple, if I am silly enough just to trade my breakout system with all the markets, including stocks, um, to take, but I'm very interested in not leaving money on the table. You really have me on that one. So explain to me what you exactly mean. I mean, just in a couple of sentences, as it relates to adjusting my basic trend following entry exit system so as not to leave money on the table and to pay attention and take advantage of this tilt.
Well, do not assume symmetry of up-down expectations in this universe. In equities, in the 4 asset classes, equities are the ones in which you have most pronounced fundamental, logical, and empirical up-down asymmetry, which is based on logic and based on empirics and in history. And when you apply it to your system, it doesn't have to be binary. It doesn't mean that if stocks are more likely to go up, you never short them. You just do something on a gradual level. It doesn't have to be binary. That's all I would say. There's many ways to do this.
Oh, okay. Well, I was thinking that what you really meant was to trade equities as a bigger part of the portfolio, but maybe I think you mean something else.
Yes. Do you allocate? I would allocate the same, and I would just not assume up-down symmetry in the expectations. And if you look at it, I mean, of course, if you study your trades in equities, I'm sure over time, or even with individual equities, I think you will notice that it's much harder. And this is a known thing in all traders, basically fundamental, discretionary, or macro. It's much harder to short equities than to be long. And there is a reason for it. This is because the table is tilted. There are things in terms of predictability. There are things in terms of the viciousness of the bottoms. The exhaustion bottoms are much more vicious than the exhaustion tops. So if you start to analyze this, and whatever strategy you use in trend following, you will probably find that much less of your money is made on shorts than on longs. And if you, let's say, for example, you analyze the equity curve of all your long trades and the equity curve of all your short trades, just take a look. You'll see how much uglier the short curve is.
That's true with all the markets.
Well, that's another subject altogether. I personally think the table is tilted in all markets because of money printing in the basement. So as more and more fiat currencies are created across the world from 1913 onwards, all markets have a slight tilt towards upwards because there's just more notional dollars and yen and euros floating around chasing the same amount of assets and services. So, but that's another story. I think that tilt is much smaller, but you can also analyze that too. And you, as you said, short curves in all asset classes look much worse than long curves, and this is exactly the reason for it.
And then, as Rich was saying, though, the portfolio impact of the shorts is one reason to take those inferior bets. And then, of course, the answer to all questions is sample size, and we throw the shorts in there to get more trades to validate our system. And then, and as I've mentioned many times, that I came up with that I share with all of my friends here, and I've done it many times, but you guys never give me credit for it. And that is that if you analyze all the different markets, currencies, commodities, stocks, and bonds, the price divided by the typical ATR that number is very low for stocks. So just from that point of view, if you use ATR, especially so CTAs and trend followers or people who use this ATR sizing, they're particularly hamstrung by shorting because almost all of the stocks, if they go to zero, it won't be anything close to an outlier because you're sizing based upon the ATR, and that's not really true for the other financial markets. And it's true, it's a problem with commodities now, but it's not a habitual problem with commodities like it is with equities.
Well, that's another problem that volatility adjustment solves. So I think we discussed this because as you go lower, let's say a stock is $100 and it goes lower and now it's $10. And if you keep the same let's say 200 share position, now you have a much less exposure. Your volatility has shrunk to 1/10. If you adjust for volatility, you'll have 2,000 shares.
Yeah,
and theoretically, you can go to zero and make infinite profits.
Yeah, I don't agree with that, but because we need to. This is good stuff to talk about next week, but the problem with that is the way you explained it. It's absolute. The price going down has nothing to do with ATR. So if ATR goes down, then that's one thing. But and then I've done a lot of research, and I haven't found that it's reliable or that volatility goes down as a big trade like the short crude in 2014. That just because the price is going down, the volatility can actually go up.
Yes, and this is very much the impact on the short-term trading. For instance, in the last month when I was trading the short gilt position, it was a very low wall, so the position size was larger. But the following week, I've taken a long position on the gilt, and this time the volatility was much larger, and both positions were profitable trades. And it's very important to capture the changes in volatility, and you can do that with short-term models. So that's the benefit of applying a short-term model. Thanks.
Of an issue for futures markets too. Take for example the futures on the VIX. It can go lower and lower. It go beyond the zero in the original contract we are trading as you're rolling into the next contracts.
Guys, we should distinguish between volatility expansion in sell-offs with volatility shrinkage as the notional value goes down. So if crude goes from 100 to 10 over 3 years, its volatility will be 10 times smaller in percentage terms. If crude goes from 100 to 10 in 2 days, its volatility is going to triple. So yes, I agree. We're not talking about crisis volatility explosion. I'm talking about adjusting to prices as their notional. This is especially valid for equities. A stock can go from $100 to $10 over 3 years without expanding volatility, just slow bleed. If you're in one long-term trade with 200 shares, now you're 1/10 the exposure in notional. If you adjust for volatility, as the volatility shrinks on a percentage basis, you will have a bigger position. Your potential profits on such a short trade will be infinite, just like they would be in upwards. So when Jerry said that a lot of CTAs have problems with ATR because, hey, this is a $20 stock and ATR is, I don't know, $2, I only have 10 ATR upside when I short it. No, your upside is infinite if you adjust for volatility.
You're right, but take for example the grains during the last decade. As you roll to the next contract, you find yourself in a higher price that can go lower again. You don't have to adjust for the volatility, and it is as if the price went negative if you take the reference of the first contract you traded, I don't know, 2010.
Hey,
Because
absolute.
because the curve is upward sloping. That's what I'm saying.
Absolute. God, I just paid $40 for coffee, a pot of coffee. This is crazy. I don't think my coffee, and I think I'm long coffee, so I don't think coffee's going up though. But anyways, I'm going to sign off and go hang out and mess around here and maybe get some more sleep. But absolute, if you could send me a spreadsheet laying out what you just talked about how you size, because I don't use ATR in the way that you were describing, which you may understand and just basically saying that I should use it the way you're describing it. But if you could put that into a spreadsheet so I could follow it, because it's a pretty interesting idea.
Okay, yeah, Jerry, I use this ATR the same way you do. It's the same way, same ATR.
Okay, yeah, I know, but I don't think you have the same formula that I use to size my positions. I know we have the same ATR, but I input ATR into a different formula than it sounds like than you do. I don't use the price of the market or a percentage. That's one of the big edges of turtle money management, in my opinion, is no percentages. Percentages, we'll have to. This is really fruitful discussion stuff. I'm really enjoying it, but I've got to say goodbye for today, and so I'll have a good weekend, everyone, and we'll chat next.